In September 2021, a company called Universal Music Group went public on the Amsterdam Stock Exchange. By the end of the first day of trading, the market had decided this company was worth $53 billion. Not million. Billion with a B. That is more than Ford Motor Company, more than most of the banks you've ever heard of, more than some entire countries produce in a year. And this company's product, on paper at least, is music. Albums, singles, songs you stream on your phone while you're doing the dishes. Now, if you sit with that number for even a minute, it does not make sense. There are only so many songs in the world, and most of them earn fractions of a penny per stream. You could play a hit track a million times, and the royalty check might come back at $4,000 or $5,000. So, how do you get from $4,000 per stream batch to a $53 billion valuation? The math doesn't work. And that's because the assumption underneath the math is wrong. But Universal Music Group is not really in the music business. Not the way you think of it. Neither is Sony Music. Neither is Warner. The three of them together control roughly 65 to 70% of a global industry that pulled in $31.7 billion in 2025 alone, and the reason they're worth what they're worth has almost nothing to do with selling songs. The real product is something else entirely. And once you see what it actually is, the whole industry looks completely different from the outside. How does a company that sells music end up worth more than most banks? It starts with one distinction that almost nobody outside the industry ever talks about, and it changes everything that comes after it. There is a difference between making a song and owning a song, and that difference is where the entire music label business model lives. Here's how it works. An artist walks into a label, or more often, a label finds an artist and offers them a deal. The label says, "We will pay for your studio time, we will pay for your producers, we will cover mixing and mastering, we will fund your music videos, and we will spend real money marketing you to the world." That package can run anywhere from tens of thousands to millions of dollars, depending on how big the bet is. And in exchange for all of that, the label gets one thing. They own the master recording. The finished track, the actual recorded performance that ends up on Spotify and Apple Music and every other platform, belongs to the label. So the artist gets the credit, but the label holds the deed. And that one detail changes everything about how the money works. Because from the moment that deal is signed, every dollar that recording generates flows through the label first, not 50%, not the artist's share minus expenses. Every dollar hits the label's books, and the label decides what, if anything, gets passed along. Now, the artist still gets credited. Their face is on the album cover, their name is in the playlist, their voice is what people hear. But credit and ownership are two completely different things, and the music industry has been built from the ground up on the gap between them. Think of it the way you'd think of a landlord and a tenant. The artist is the tenant. Their name is on the mailbox. They live in the house. Everybody who drives past points at the building and calls it their home. But the landlord built the house, the landlord holds the title, and the landlord collects rent from everybody who walks through the front door, parks in the driveway, or plugs into the electricity. Everybody in the neighborhood knows the tenant's name. But the rent check goes to the landlord every single month. That is exactly how a record deal works. Every time somebody streams that song on Spotify, the money hits the label's account before it ever reaches the artist. Every time a radio station plays it, the label collects. Every time it gets placed in a TV show, a movie, a car commercial, a video game, the label collects again from a completely separate check. And here's the part that makes the whole model so different from almost any other business you can name. The label keeps collecting long after the artist has moved on to a different deal, a different label, or a different career entirely. A song recorded in 1985 that still gets streamed today is still sending money back to whoever owns that master. And in most cases, that is not the person who sang it. This is why old music is worth so much money. And I mean genuinely staggering sums that would make you question whether you're reading the decimal point right. A catalog doesn't retire when the artist does. It doesn't slow down when the artist stops touring. It doesn't go on vacation. It just keeps working, quietly, in the background, collecting from every platform in every country, every single day, whether the artist is on stage or sitting at home watching television. Bob Dylan's songwriting catalog sold to Universal Music Publishing for an estimated $300 to $400 million. His master recordings went to Sony in a separate deal for roughly another $200 million. Add those up, and you're looking at over $500 million for one artist's body of work. And Dylan hasn't released a major studio album in years. He doesn't need to. The catalog is the product now, and the catalog has been the product for a very long time. Bruce Springsteen sold his entire package, both the recordings and the songwriting rights, to Sony for $500 million. That deal closed in late 2021. Paul Simon sold. Stevie Nicks sold a majority stake. Neil Young sold. And in every single one of those transactions, the buyer was not paying for nostalgia or sentimentality. They were paying for a building that never stops collecting rent. The reason those prices are so high is that the income is predictable. A song that's been earning royalties for 30 years will almost certainly still be earning royalties in year 31. Streaming made every old song permanently available, which means a track from 1975 that would have gone out of print in the CD era now sits on Spotify, earning fractions of a cent per play, indefinitely, across every country, with an internet connection. That is not a one-time sale. That is a recurring revenue asset, and labels have been building portfolios of these assets for decades. So that's the simple version. The label owns the asset, and the asset pays out every time somebody, somewhere, presses play. If that makes sense so far and you want to see how deep this rabbit hole actually goes, hit subscribe, because what comes next is the part nobody talks about. Owning the recording is only the beginning. What a label can actually do with that ownership, the number of completely separate revenue streams they've figured out how to extract from one single song, is where the real machinery kicks in. When a label owns a recording, it doesn't just sit back and wait for streaming royalties to trickle in. That's one door. The label has figured out how to open at least 4 or 5 completely separate doors inside the same building, and each one pays independently of the others. The first thing you need to understand is that there are actually 2 separate copyrights sitting inside every song. The first is the master recording, the specific performance we just talked about, the thing the label typically owns. The second is the composition, which is the song as it was written, the melody, and the lyrics, before anybody ever pressed record. Those are 2 different legal assets, and they generate 2 different streams of income. When a label also controls the publishing rights to the composition, which many of them do through their publishing arms, they are collecting from both sides of the same song every time it gets used anywhere. Here's where the money multiplies. That composition generates what's called mechanical royalties every time the song is streamed, downloaded, or pressed onto a physical record. It generates performance royalties every time the song is played on the radio, broadcast on television, performed live in a venue, or even piped through the speakers at a restaurant or a retail store. And then there's a third category called synchronization fees, and this is the one that changes the math completely. A sync fee is what gets charged when someone wants to use a song in a piece of visual media. A TV show wants to play your track during a dramatic montage, they have to pay a sync fee for the right to pair that music with their footage. A car company wants it in a commercial, sync fee. A movie director wants it over the closing credits, sync fee. A video game developer wants it on the soundtrack, sync fee. And here's the important detail. Both the master owner and the publishing rights holder get paid on each sync deal, typically a 50-50 split between the two. A label that controls both sides collects the entire check, and these are not small numbers. A placement in a local TV ad might run $1,000 to a few $1,000s. A national television commercial pays somewhere between $15,000 and $250,000. A major global brand campaign for a well-known song can cross $500,000 for a single placement. And every one of those fees is separate from the streaming royalties, separate from the radio play, separate from everything else the song is already earning just by existing. Universal Music Group's publishing division alone pulled in roughly $2.6 billion in 2025, just the publishing arm. And their sync licensing revenue specifically grew 15.3% year over year in the first quarter of 2026, hitting $79.6 million in a single 3-month window. That's the kind of number that makes accountants cry. And that's from sync alone, in 1 quarter at one label. So a single song is simultaneously earning from streams, from radio airplay, from live performance broadcasts, from physical vinyl and CD sales, from sync placements in film and television and advertising and gaming, and from mechanical royalties on the composition itself. One song, 5 or 6 completely separate checks, all flowing back to whoever holds the rights. And the label, in most traditional deals, is holding the rights to both the recording and the publishing. That means one song owned by one company, generating income from half a dozen different directions at the same time, none of which requires the artist to do anything at all. Pay attention to this next detail, because it explains everything about why the modern label looks the way it does. Publishing and sync are what the label earns from the song. What comes next is what the label earns from the artist. For most of the history of the music industry, a record deal was exactly what it sounds like. The label funded the record, the label owned the record, and the label made money when the record sold. Everything else the artist did, their touring, their merchandise, their endorsement deals, that was the artist's business. The label didn't touch it. That changed, and the change has a name. It's called the 360 deal, and it is now the standard contract at every major label. Here's how a 360 deal works. The label still does everything it always did. It pays for recording, production, marketing, distribution, but instead of only taking a cut of the recorded music, the label now takes a percentage of essentially everything the artist earns. Touring revenue, the label gets a piece, typically somewhere between 10 and 50%, depending on how much leverage the artist has at the negotiating table. Merchandise sales, the label gets a piece, usually 10 to 25%. Brand partnerships and endorsement deals, the label gets a piece. If a shoe company pays an artist $1 million to wear their sneakers, the label takes its contractual share of that check too. Go back to the landlord analogy for a second. Imagine your landlord not only collects rent on the building you live in, but also takes a percentage every time you sell lemonade on the front porch, every time someone pays you to wear a t-shirt with their logo on it, and every time a company hires you to show up at an event. That's a 360 deal. The label is making money off everything the artist does, not just their recordings. Now, layer on top of that the way the money actually flows. When a label signs an artist, it gives them what's called an advance. This is the cash the artist gets up front. The recording budget, the living expenses, the marketing spend, sometimes hundreds of thousands or even millions of dollars. And from the outside, this looks like a paycheck. It looks like the label is investing in the artist and paying them for their talent. It is not a paycheck, it is a loan. The label calls it an advance because it is money advanced against future royalties. From the moment that advance is paid, every dollar the artist earns in royalties goes back to the label first, to pay off the advance. The artist doesn't see a single royalty check until the label has recovered every penny it spent. That process is called recoupment, and in a lot of deals, it never happens. The artist never earns enough to pay back the advance, which means the artist never sees royalties at all. The label, meanwhile, still owns the master recordings from that deal forever. And it gets more complicated than that. Many label contracts include something called cross-collateralization, which means the label can combine the financial performance of multiple albums under the same contract. So, if an artist's second album is a hit, the royalties from that hit can be used to pay off the unrecouped balance from the first album before the artist sees any money from either one. The label pools the wins and the losses together, and the losses always get paid first. If you're wondering how that's even legal, so is everyone else. But it is legal, and it is industry standard, and it is the reason why so many artists you've heard of, artists whose songs you've streamed millions of times, have talked publicly about being broke, while their labels are reporting record profits. But forget for a second whether this system is fair. Look at what happens when you zoom out and see these companies for what they've actually become. Because this isn't just about one artist or one deal anymore. When you pull back and look at what these companies have become at the corporate level, the picture changes completely. While we've been looking at how one artist's deal works, something much bigger has been happening at the corporate level. And it changes what you think a music label actually is. When Universal Music Group signs a new artist, they are not betting on a hit single. They are not gambling on whether one song goes viral on TikTok or whether one album debuts at number one. What they are doing, in financial terms, is acquiring a long-term income-producing asset. The advance they pay is the purchase price. The recordings they own are the asset. And the revenue that asset generates over the next 20, 30, 50 years is the return on investment. No creative company thinks that way, but a holding company does. And that is exactly what the major labels have become. They are intellectual property holding companies that use artists as their primary acquisition vehicles. Look at the catalog deals again through this lens. Bob Dylan's combined catalog sold for more than $500 million. Springsteen's went for $500 million, but those weren't sentimental purchases. Universal and Sony didn't buy those catalogs because they love classic rock. They bought them because a catalog that has been generating predictable royalty income for 30 or 40 years is an asset you can model. You can forecast its revenue. You can project its growth rate based on streaming trends. You can calculate its yield the same way you'd calculate the yield on a rental property or a bond. What the label is really paying for is the catalog. The artist's career is the process that builds it. This framing explains something that confuses a lot of people about the music industry. Why do labels keep signing artists who might never be profitable on their own? Why pour money into a debut album that barely breaks even? Because the label isn't trying to make money on that album. The label is trying to acquire the recording. If the artist breaks through, the catalog becomes enormously valuable. If the artist doesn't break through, the label still owns the masters, still earns from whatever streams those recordings generate in perpetuity, and the sunk cost of the advance is just the price of doing business. It's the same logic a venture capital firm uses. Fund 10 bets, expect 7 to lose money, and make it all back on the 3 that hit. And the scale of these companies goes way beyond what you'd expect. The 3 major labels, Universal, Sony, and Warner, collectively control roughly 65 to 70% of the entire global recorded music industry. That is an industry that generated $31.7 billion in 2025. Universal alone posted $14.4 billion in total revenue that year. Sony's combined recorded music and publishing revenue topped $3 billion in a single quarter for the first time in the last quarter of 2025. These are not boutique creative shops. These are global corporations with market capitalizations in the tens of billions, and the asset on their balance sheet is a library of songs. Every time you stream a song, play music at a wedding, hear a track in a movie trailer, or walk into a store where something is playing over the speakers, the odds are roughly 7 in 10 that the payment for that usage flows back to one of 3 companies. 3 companies. 70% of that entire market. And the bulk of what they're selling is the right to use music they recorded years or decades ago. But here's the part that even people inside the music industry don't fully appreciate. If a music catalog is a financial asset that appreciates over time, pays a steady income stream, and can be modeled and forecasted the way you'd model a bond or a piece of real estate, then it was only a matter of time before Wall Street noticed. And Wall Street didn't just notice. Wall Street showed up in 1997 with an idea that turned songs into something nobody had ever imagined they could become. There's another layer to this that hardly ever comes up, and it has to do with who controls the pipes. The major labels don't just own music, they also control distribution. If you're an independent artist trying to get your music onto Spotify or Apple Music, you can use a service like DistroKid or TuneCore, and those services will put your songs on the platforms for a flat fee or a small commission. But the majors don't need those services. Universal, Sony, and Warner each run their own massive distribution arms that handle the logistics of getting music from the label to the listener at a global scale. And those distribution arms don't just serve their own rosters. They also distribute music for independent labels and artists who want the reach and infrastructure that only a major can provide, in exchange for a piece of the revenue. So the label isn't just the landlord who owns the building. The label also owns the road that leads to the building. If you want your music in front of the largest possible audience, the most efficient path runs through one of the 3 companies that already dominate the market. Now think about the value of the assets these companies are sitting on, and think about how that value behaves over time. This is one of the strangest things about the music business, and it's the opposite of almost every other industry. Most consumer products lose value the moment they're sold. A new car is worth less the day you drive it off the lot. A new phone is worth less the week after the next model drops. Music is the opposite. Old music that was recorded 20, 30, 50 years ago, is more valuable today than it has been at almost any point since it was released. Streaming did that. Before streaming, a 1975 album would eventually go out of print. The CDs would stop being manufactured. The revenue would taper off. But streaming made every song ever recorded permanently available. A track from the 1970s now sits on Spotify right next to this week's number 1, earning fractions of a cent per play indefinitely across every country with an internet connection. And that means the value of what the labels own keeps going up year after year without any new investment. That is why UMG's 2021 IPO priced the way it did. Vivendi, the French conglomerate that had controlled Universal for 20 years, spun off 60% of UMG's shares to its existing shareholders and listed the company on the Amsterdam exchange. No new shares were created. UMG didn't raise a single dollar of fresh cash. The whole exercise was just the market being asked to put a price on what Universal actually owned. And the market's answer was $53 billion. That's not a typo, by the way. The world's largest music company went public, and the market said the catalog alone was worth more than Ford. And those revenues have been climbing for 11 straight years, with streaming now accounting for 69.6% of the total, more than $22 billion. That growth is accelerating, and every percentage point of growth makes the catalog sitting on the majors' balance sheets more valuable. And that brings us to the strangest part of this story. The moment that songs stopped being songs and started being something else entirely. If you're still here, and this has changed how you think about the music industry, hit subscribe, because what I'm about to tell you is the detail that makes the entire picture click. If a music catalog is a financial asset that appreciates over time and pays a steady income stream, then Wall Street was always going to show up eventually. And Wall Street showed up in 1997 with a deal so unusual that they named it after the artist. In 1997, David Bowie sat down with an investment banker named David Pullman and did something that had never been done before in the history of the music industry. They took the future royalty income from 25 of Bowie's albums and turned it into bonds. Actual, tradable, Wall Street bonds. $55 million worth, paying investors a fixed 7.9% annual yield over 10 years. Prudential Insurance Company bought the entire issue. The financial press called them Bowie bonds. And for the first time in history, a song catalog had been turned into a financial security, the same category of instrument as a treasury bond or a mortgage-backed security. Think about that for a second. A portfolio of rock and roll albums from the 1970s and 1980s was packaged, priced, and sold to institutional investors the same way you'd sell a package of home loans. The royalty checks from Space Oddity and Heroes were now the coupon payments on a fixed income instrument sitting in the portfolio of an insurance company. The songs didn't change. What changed was how the financial system saw them. The financial system had turned them into collateral, an asset class that bankers could package and price and sell. And that idea didn't stay small. In 2018, a man named Merck Mercuriadis, who had previously managed artists, including Beyoncé and Elton John, teamed up with Nile Rodgers to launch something called the Hypnosis Songs Fund. The pitch was straightforward. Music royalties are predictable, long-duration cash flows. They behave like bonds, but with better growth potential because streaming keeps expanding the addressable market. So, Hypnosis went on a buying spree. Over the next few years, they spent more than $2 billion acquiring 146 separate song catalogs, totaling 65,413 individual songs. Justin Bieber's catalog, Shakira's catalog, Neil Young, the Red Hot Chili Peppers, Leonard Cohen, all of it bundled into a single fund and listed on the London Stock Exchange, where ordinary investors could buy shares the way you'd buy shares of any other publicly traded company. At its peak, the Hypnosis catalog was valued at $2.55 billion. And then, in 2024, the private equity firm Blackstone, one of the largest alternative asset managers on the planet, bought Hypnosis for $1.6 billion. Blackstone had already invested $1 billion into a related arm of the company back in 2021. A private equity giant that manages real estate portfolios and corporate buyouts was now in the business of owning pop songs. And it wasn't just Blackstone. Securitized music catalogs have attracted institutional investors you would never expect to see anywhere near the music industry. Pension funds, sovereign wealth vehicles, insurance companies. The state of Michigan's pension fund has exposure to music royalty-backed securities. Your retirement money, the money sitting in a fund that's supposed to pay your pension when you're 65, might be partially backed by the royalty income from songs you hear at weddings and in car commercials and in the background at grocery stores. That is the deeper truth about how music labels make money. They don't sell music. They build, acquire, and manage portfolios of intellectual property assets. Those assets generate multiple independent revenue streams from streaming, radio, sync licensing, publishing, and 360 deal cuts of everything the artist does. And those revenue streams have been packaged into financial instruments and sold to Wall Street, to private equity, and to pension funds. When you put all of that together, the label business has become a branch of finance that happens to deal in songs. The song playing at your cousin's wedding, the track in the truck commercial, the beat in the video game your kid plays after school, there is a very real chance that the rights to that music are partially owned by an investment fund, a private equity firm, or a public pension system. The music hasn't changed, but the ownership of the music has been absorbed into the same financial infrastructure that manages your mortgage and your retirement account. Remember that $53 billion valuation that didn't make sense at the start of this video? The number that seemed impossible if you thought of a music label as a company that releases albums and sells songs? It makes perfect sense now. You're not pricing a music company. You're pricing a portfolio of income-producing intellectual property assets that appreciates every year, generates revenue from half a dozen separate streams, and pays out every time someone, somewhere in the world, presses play, flips on the radio, walks into a store, watches a commercial, or loads a video game. And those assets have been validated by Wall Street, by private equity, and by pension funds as a legitimate investment class, right alongside real estate and government bonds. So, what is a music label, really? It's a financial company. It has more in common with a hedge fund or a real estate firm than with a recording studio. The artists make the music. The labels own the music. And the difference between those two things is worth tens of billions of dollars. Tell me in the comments where you're watching from, and if this changed how you think about the music industry, subscribe. I'll see you in the next one.